Hi, and welcome back to Auction Market Theory 101 in this order flow mastery course. And we will lay down in this video and the next few ones the basics of understanding of the liquidity auction theory model, which is the ultimately realistic model to analyze market structure based on facts, based on data, based on reality, that deletes all the fluff, all the I think, all the my opinion is, and most of the stuff that you normally are fed in social medias. And we start from this model, okay? Which is a very simple model. Consolidation, balance, fair value, imbalance, no fair value, search for liquidity, price discovery, and then again, balance. Okay? These are the main phases of the auction market theory model. Why does this happen? Well, let's imagine that, as we know, let's say we start from here. We have all of these passive sellers, all of these passive buyers, and there's sellers aggressing the bid, buyers accepting and lifting the ask. And the double auction keeps moving price up and down, up and down. And throughout all of this phase of the market, all four of our forces, passive buyers, passive sellers, aggressive buyers, aggressive sellers, are in a situation of balance where you'll typically see from the volume profile a situation of fair value and a lot of money being traded throughout all the range. And this is a situation where both forces are agreeing that this is a fair price to trade. That's what we have to understand from this. Because as we know, markets move because of the variation in the perceived value of the underlying asset. So whenever we think that, both sellers and buyers, aggressive and passive, think that this range of price is fair, it's a fair valuation, where it's fair to trade, where it's fair to sell and to buy, both aggressively and passively, in a way that makes price action balanced, that will keep the price around the same range. Because of the trading activity that happens behind, makes us understand that that's a fair price for the market. That whenever we try to auction in the higher prices, there's more of a bias to sell. And whenever we move to the lower ranges of the range, there's more of a bias to buy. So a situation of balance is the ultimate description of a fair valuation. That's why we call this the fair value area. But something happens. Something might happen. A news might come out, as we remember the example with Apple. Well, when Apple releases its earnings and it's way higher than expected and they're making a lot of money, well, the perceived valuation of the Apple stock will rise. So if before buyers and sellers were agreeing that this was a fair price to trade, well, sellers might not agree anymore that this is a fair price to trade. Aggressive buyers instead, and all sorts of buyers, will agree that this is a fair price to buy, this is a fair price to buy, this one is as well, this one is as well, and all of these ones are fair prices to buy. And to aggressively accept paying slightly higher prices as long as they can get their hands on the underlying asset. And this shift in the auction typically happens either because, in the most stupid example, something happened, a news came out, or because the net pressure of long-term market participants, taking into consideration the fundamental value, so this fundamental bias is long, and most institutional traders will typically split their orders, right? They will not put their order in the market all at once, but they will fraction it, okay? And they will fraction it in order to not have this impact on price, so that they can get a better fill, right? Because if they were to buy all of these orders all at once, what will happen? They will buy some here, 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 and their average price would be here, for example. But if they buy just a little bit, wait till more aggressive passive sellers come, and then buy a little bit more, and then buy a little bit more, where now their fill is here instead of being up here. So for an optimal execution of these huge orders that big banks, hedge funds, and all of the smart money market participants have to go through, in order to get a better feel of this mass of orders, they will typically fraction their orders, right? And a lot of the order flow you're going to see comes from this perfectly cadenced rhythm of fractional institutional orders, right? And at some point, one of the two flows might outflow the opposition, okay? So in the most stupid example, this happens because of a change in the fundamental perception, but it also could be a continuation of the current perception. Because maybe they just need to pour more money in the market to fill all of their positions, so the auction just goes higher, right? And if I had to ask you a question, right? These buyers that are buying and paying a spread, do they like paying a spread and constantly get filled at worse and worse prices? Do they like it? Not really. What would be the ideal scenario for them? That a huge seller in the book was here, they would buy into it, he would absorb all of them so they can get a good fill because they think price will go up anyways, so they get a better fill. But sellers are not present. Not as much. The book is thinner on the sell side. So what they're actually doing when they're pushing price up, because of this aggression, is intrinsically looking for liquidity. Looking for counterpart. Looking for an easier way to trade that, they don't get filled at worse and worse prices. They're looking for sellers that consider these prices fair. And they might not find it for a long time. But at some point they will, because prices will rise. And now also the sellers will start seeing this level of price as a fair price to trade, as a fair price to sell. So we will find ourselves again in a situation of balance, where both forces, aggressive buyers, aggressive sellers, passive buyers, passive sellers, agree that this is a decent price to trade. And that's where you see a lot of volume going on. Again, a lot of trading activity. This is where smart money prefer to trade because there's a lot of liquidity, there's not a lot of price movement, they can get their fill very optimally. And that's where the auction clearly tells us something that price action is explaining as a consequence of volume. That the market from both sides is accepting that this is the new fair valuation, that this is the new fair price. Before, this was the fair price. Now this is the fair price. So the auction is likely to keep bringing price up. Okay? This is when a trend is qualified. So not just this, with highs and lows and highs and lows. We want to see this. Market agreeing that that's a fair price on both sides. Not for a small price swing, for a long time. We need proof that all the institutional order flow is on our side. And this is the basics of the auction market theory model. So you got a balanced market, a fair value area, an imbalanced market, and then again a balanced market. Let's get deeper. It's not just going to go like this, okay? It's likely going to go like this, right? And the next level into framing this in a way that is more realistic is introducing failed auctions, okay? And by failed auction, we mean one of the two parties of the auction auctioning higher, for example. So an attempt to break, that does not happen. Because either aggressive sellers take control of the market, or because this phase of aggressive buying exhausts and aggressive selling starts to take control again and brings price back in a situation of fair value and the auction in a situation of balance. This is what we call a failed auction. Could happen on the other side, right? All of these buyers are considering these prices to be fair enough to push price higher. And if sellers do the same thing and they try and auction lower, well, you could expect the same buyers that bought here, well, now they're going to consider these prices even cheaper. So you're going to have some form of pressure that will lead prices back up in a situation of balance. So this attempt of one party to search for lower liquidity that fails, to try a new price discovery phase that fails, we call failed auction. And it can come in a bunch of different fashions. It could either be an exhaustion from sellers and buyers taking the upper hand again, or it could be sellers being absorbed, that they try to actually push, but they find a wall of passive buyers, and then they simply give up and buyers take the upper hand. So it can either be a dry up in sell volume while going down, or an absorption from buyers. Same thing over here, either a dry up in buy volume, or buy volume increasing but finding a wall. That, like Gandalf, right? You shall not pass. And then sellers taking the upper hand. Same thing over here, right? We had 2 times a failed auction. The sellers try to auction lower and accept paying lower prices. But the same buyers that considered this, and this is even more powerful, the same buyers that consider these prices to be completely fair, actually super cheap, driving the auction higher, causing a situation of imbalance, well, those ones now are going to be very hungry to buy more. And any attempt to exit the fair value has a higher likelihood of failing than creating a new auction, because you have this to deal with first. You have these prices to deal with first. And buyers were considering these super cheap in a very recent time. But at the same time, sellers might be ready to keep the buyers in check above here. Every time buyers try to attempt auctioning higher, these are prices that for sellers are considerably cheap, or in this case, a really good premium to sell. And they will push price back into balance. This is what will happen most of the time. Price will attempt to break out. There's only one breakout that works. Only one actually breaks out, because it breaks out. These ones are attempt to break out, that simply breaks back in. And we call these failed auctions. So you will tend to see areas of balance, areas of imbalance that will coincide with areas of fair valuation from the perspective of volume, low volume areas, and then high volume areas again. Just like this. Areas where market agreed on a price, stayed there a bunch of time, and traded a lot of money. Areas where not a lot of volume was traded, not a lot of money was traded, not a lot of time was spent there, but the auction was way more aggressive. So still very significant. These, by the way, are the best, absolute best trading setups, because you both get the strength of the imbalance, the exit from fair value, and a situation where buyers are also keeping the sellers in check in a situation of fair value. And sellers likely considering these prices a little more fair than these ones. So in a situation like this, where we'd like to take a look at price action, we'll not just draw highs and lows as visual reference points, because this is Dow theory, right? Market is high, market is low, market is going high, market is going low, so higher high, higher low, we're an uptrend, good boy. Yeah. We'll take a look at the market in this way. Where's the most volume traded? Where did the price try to auction? And what happened after? What was the effort? What was the result? This is a much more rational way of looking at markets, because it's based on facts, it's based on data, it's based on volume.